Welcome back to the deep dive. Today we're undertaking a very specific, detailed mission. We want to understand the extraordinary strategic puzzle that is American Express, or AXP.
Right.
We have dissected a stack of research, a really deep-cut investment report that treats AXP not just as a card in your wallet, but as a kind of structural anomaly in the global payments ecosystem.
And that anomaly is, I think, precisely why this deep dive is so necessary.
Yeah.
Most people, they just slot AXP into one category or another. It's a luxury brand, or it's a bank, or it's a network.
But it's not any of those things alone.
Not exclusively, no. It operates as a true hybrid. It's simultaneously a closed-loop payments network, a crucial merchant acquirer, and a large-scale card-issuing bank.
All three at once.
This three-in-one model, it defines their entire economics.
And that integrated identity, that combination of roles, has allowed them to execute this massive multi-year strategic pivot.
It really has.
They are aggressively moving away from being the company that, just served traditional business travelers and entertainers.
The old T&E designation.
Exactly. And they're successfully morphing into a diversified premium lifestyle brand, and one that appeals to a much, much younger audience.
And we can see the proof of concept in their financial results.
Yeah.
The data we're looking at through fiscal year 2024 and Q3 2025, it shows record revenues and a durable double-digit growth profile.
That's the good part of the story.
That is the successful part of the story, absolutely. Yeah. But our mission, as defined by the sources, is to analyze that impressive success against the inherent structural risks that come baked into that hybrid model.
Because if they were just at a network like Visa or MasterCard, they wouldn't have the same worries.
Not at all.
But since they're a lender, they retain direct, unavoidable credit exposure.
Exactly. And that exposure, combined with these intensifying regulatory challenges, everything from the potential impact of Basel-Fen game rules to the Credit Card Competition Act, it just creates a very complex picture.
So it's high growth, high moat, but also high cyclical risk.
You've got it. That's the trade-off.
Okay, let's unpack this. The core thesis we're taking away from this analysis, it really breaks down into a clear duality.
Yeah, push and a pull.
Yeah. On the positive side, AXP has proven it can fundamentally rewire its customer base. They have successfully courted younger, higher spending demographics,
right,
millennials and Gen Z.
And done so at incredible speed.
Which, secures their future cash flow.
That success is undeniable. But it doesn't change their structural constraint.
The counterbalance.
The counterbalance is that AXP's balance sheet is inherently and fundamentally sensitive to macroeconomic downturns.
Right.
When the consumer suffers, AXP suffers.
Right.
Why? Because they are on the hook for those credit losses.
Unlike their peers.
Their pure network peers, Visa and MasterCard, are totally protected from that cyclicality. They offload the credit risk to thousands of separate issuing banks.
Got it.
So understanding that vulnerability is essential, even if the growth narrative is, just brilliant.
To truly appreciate the scale of their success and those inherent risks, we have to start where it all begins.
The foundation.
The foundational structure of the company. Let's dive deep into Section 1, the closed-loop advantage, their core economic moat.
Okay, so think about how, 95% of credit card transactions work globally.
The normal way.
The normal way. They operate on what is called the four-party model, and this is epitomized by Visa or MasterCard.
Okay, 4 parties.
You have the consumer, you have the merchant acquirer, which is the bank that services the merchant.
Right, the bank that owns the little terminal on the counter.
Exactly. And then you have the card issuer, which is the bank that holds your account, the one that sent you the card.
So 4 different players all have to talk to each other.
And the network, Visa or MasterCard, acts as the central switch in the middle. Coordinate everything.
It sounds like a lot of moving parts.
It is. AXP, however, it compresses that model entirely. They utilize what's called the three-party model, or a closed loop.
Okay.
And this is the foundational secret sauce.
Go ahead.
American Express handles 3 roles simultaneously. They are the issuer. They hold your specific customer relationship. They are the acquirer. So they hold the direct relationship with the merchant where you just sweat the card.
So they have both sides.
Both sides.
Yeah.
And they are the network, the pipes that connect those two sides. It's an integrated proprietary ecosystem.
So if I use my American Express card at a local restaurant, I am only dealing with 2 entities.
Right.
Me and AXP.
That's it?
It makes the transaction flow internal and, I imagine, incredibly efficient. So why does the structural difference translate into such massive economic advantages?
Well, it buys them two huge strategic advantages that their competitors can only dream of.
Okay.
Absolute data fidelity and absolute pricing power.
Let's start with the data, because in the 21st century, that is the most valuable commodity.
Precisely. Because AXP sees both sides of the transaction, the identity of the cardholder and the specific inventory codes on the merchant side, they capture what is known as Level 3 data.
Level 3. What does that actually mean in practice?
It means it's not just the total amount you spent at a particular store. This is line item detail.
We're kidding.
No, they know the exact products you purchased, the quantity, and the tax applied. So not just that you spent $50 at the pharmacy, but that you bought two specific items for $20 and $30.
That is granular. It means they know your specific consumption habits, which, for a lender, must be a goldmine.
It truly is. And this proprietary data feeds directly into the predictive analytics engine, which they call Amex Advance.
Amex Advance.
And this engine is the reason AXP can offer hyper-personalized marketing. They know precisely when to offer you a discount or a reward for a specific item at a specific store.
Because they know you buy it.
They know you buy it regularly. And, more critically, for a company that lends money, this superior proprietary data allows for the most formidable real-time fraud detection and underwriting capabilities in the industry.
Wow.
It gives them a massive information edge when they're assessing risk for new cardholders or managing the existing credit lines.
So the closed loop isn't just some accounting trick. It's an intelligence apparatus that makes them a better lender and a better marketer.
It's the moat they built before data was the buzzword.
Yeah.
It's truly foundational.
Now, let's talk about that second major advantage you mentioned. Pricing power, which the sources call discount rate sovereignty.
Yes.
This is where the money is made to fund those famous rewards programs.
This is the critical economic difference. In the four-party system, the issuer banks and the acquirer banks, they argue over the interchange fee.
Which is just a standardized fee.
Right, the standardized, often regulated fee set by Visa or MasterCard.
Right.
AXP bypasses that entire messy structure. They negotiate the discount rate. The fee they charge the merchant directly with that merchant, one-on-one.
They just set their own price, and the merchant either accepts it or doesn't.
That's the essence of their sovereignty. And this allows them to capture a significantly larger portion of the transaction value, which they categorize as discount revenue.
So how much bigger are we talking?
The source material points out that AXP fees average roughly 2.3% to 2.5% of the transaction value.
And how does that compare to competition?
It's substantially higher. For their peers in the open-loop system, the average transaction fee usually hovers closer to, say, 2.0% to 2.2%.
Okay, so a few tenths of a percent.
That difference, an extra 20 to 30 basis points on every single transaction, is absolutely fundamental.
I see.
It's the excess profit they need to fund the incredibly rich, high-end rewards and benefits.
The airline transfer partners, the lounge access, the concierge service.
All of it. The things that attract a high-spending customer in the first place.
So the high merchant fee is the engine that pays for the high rewards, which in turn attracts the premium spender, who then justifies the high merchant fee to the merchant.
You've defined the virtuous cycle perfectly.
It's a self-reinforcing, very profitable loop.
And without that structural pricing power, AXP's premium model, it just falls apart.
But wait, isn't that agility also a risk? You mentioned that AXP can roll out product refreshes and underwriting changes rapidly since they don't need to coordinate with thousands of third-party banks.
Right, they can move fast.
If they get a big product change wrong, say they misprice a reward or a benefit, they don't have thousands of banks to spread the pain across. Doesn't that make product launches and policy changes inherently higher stakes for them?
That's a really insightful point, and it speaks to the high-stakes nature of the closed-loop model.
Yeah.
Yes, their agility is a double-edged sword.
How so?
Well, if Chase launches a new feature, they know that hundreds of other issuers will eventually copy it, right? It spreads the competitive pressure. If AXP launches a new platinum feature, they bear the entire cost and the entire risk of adoption failure.
So the upside is speed, but the downside is concentrated risk.
Exactly. But the flip side is strategic speed. If they need to pivot their entire fraud detection algorithm overnight because of a new threat, they can.
They don't have to ask anyone for permission.
They don't have to wait for the entire open-loop ecosystem to update its software. In a world defined by speed, that instant proprietary deployment capability is often viewed as being worth the higher execution risk.
So this agility helps them manage product, underwriting, and risk. But where does all this structural advantage really show up on the financial statements?
Ah, okay.
Let's pivot now to Section 2, AXP's diversified revenue mix. We're talking about the three engines.
This is the financial manifestation of that hybrid structure. AXP earns money through three distinct, large engines, and the diversification among these is key to their stability, though maybe not their cyclicality.
Okay, let's start with Engine 1, discount revenue. This is the transaction engine we just discussed.
And it remains the largest, most crucial engine. It makes up about 53% of total net revenue.
And in dollar terms.
In fiscal year 2024, discount revenue hit a staggering $35.19 billion.
Wow.
Yeah, and this is the clearest expression of their spend-centric model.
Which means they profit substantially even if the customer is financially responsible.
Precisely. Unlike a traditional credit card company or a regional bank that relies heavily on interest income, AXP's core customer base is largely composed of transactors.
People who pay off their balance in full every month.
Exactly. AXP profits by collecting that merchant discount rate on every single swipe.
So what's the key characteristic of this revenue stream?
Its sensitivity. It is highly correlated with the macro environment. So consumer confidence, discretionary spending, business capital expenditures.
When people feel rich, this engine flies.
It flies. And when they feel nervous, it slows down immediately.
Now for the second engine, net card fees, and this is the one that really separates AXP from traditional lenders. This is the subscription engine. Here's where it gets really interesting for me. Why is 5 years of double-digit fee growth so unheard of in this space?
It's almost unprecedented because it violates the normal rules of commoditization. We are talking about 5 years. That's over 20 consecutive quarters of double-digit growth in card fee revenue.
That's incredible.
In 2024, this stream reached $8.45 billion, growing 16% year over year.
That level of growth in subscription pricing implies immense pricing power and really strong brand inelasticity.
You'd have to.
It means the benefits they provide must outweigh the cost of the fee, even as they hike that fee year after year.
That's exactly the premiumization strategy at work. AXP has deliberately and successfully increased the annual fees on its flagship products.
We've all seen it. The Platinum card is now, what, $695 annually?
It is. And the Gold card is at $250, and customers are still signing up. Psychologically, people are willing to pay for status and access. They view the card not just as a payment tool, but as a subscription to an elevated lifestyle, complete with airport lounge access, status and hotel programs, curated dining experiences, all of it.
I think we need to pause and just emphasize the implication of this fee growth. This is revenue that is not dependent on the economy or interest rates.
It's absolutely critical because it acts as a stabilizing, recurring, subscription-like buffer against macroeconomic volatility.
Okay.
If the economy tanks, discount revenue falls, and loan losses surge. But those, $8.45 billion in card fees? They are still collected.
Regardless of whether the customer flew or ate out or carried a balance.
Yeah, exactly. This stable base justifies a significantly higher valuation multiple than a bank that relies purely on lending.
And finally, engine 3, net interest income, the lending engine. This is where AXP takes on the risk that Visa and MasterCard famously avoid, and where the sources of that cyclicality are most apparent.
This is AXP operating freely as a bank. They hold the credit risk right on their balance sheet.
And what did that look like in 2024?
In 2024, net interest income was $15.5 billion, which was an 18% increase.
An 18% jump.
Yeah, and this surge in 2024 was primarily driven by two factors. First, the sustained high interest rate environment, which makes their loan book inherently more profitable.
Right. Higher rates mean higher interest payments.
And second, just the growth in revolving loan balances among their customers.
Yeah.
More people were carrying a balance.
So if interest rates fall, this engine takes a hit, regardless of spending volume.
Precisely. And internally, AXP is keenly aware that traditional credit revolving is only one way to monetize their loan book. They have heavily pushed what they call lend-centric initiatives like Planet.
Okay, elaborate on Planet for the listener. Why does AXP need its own internal buy now, pay later functionality?
They need it because the competitive landscape is changing so rapidly.
Right.
In the past, if a customer needed to finance a large purchase, they would just revolve that balance on their card at the high APR, or maybe get a personal loan.
But now there are other options.
Now, competitors like Affirm, Klarna, and even the internal BNPL features offered by Visa and MasterCard are capturing that financing wallet share at the point of sale.
So Plan, it is a defensive move.
Plan here. It allows AXP customers to take a large purchase, say a new computer, and move it into an installment plan with a fixed monthly fee rather than that high variable interest rate.
And that keeps the loan on AXP's books.
This ensures AXP captures the financing need, keeping the balance sheet asset internal and preventing customers from going to a competitor. It's a defensive and an offensive move rolled into one.
That brings us perfectly to the strategic pivot itself, Section 3. It's not enough to just have a great structure. You need the right customers to run through it.
Right.
And AXP has fundamentally reinvented its demographic profile.
This transformation has been the management's top priority, encapsulated in the growth plan they initiated post-2022.
And what was the goal of that plan?
The entire strategy is centered on sustaining double-digit revenue growth and mid-teens EPS growth. And they knew they couldn't do that, relying on the traditional aging baby boomer base.
So the key driver has been a massive commitment to marketing spending, which the sources note is north of $5 billion a year.
That scale of spending is very deliberate. Management essentially made a capital commitment to buy future market share, specifically targeting millennials and Gen Z.
It's an acquisition strategy.
Absolutely. They recognized that while their existing customers were incredibly loyal, if they didn't successfully acquire the next generation of peak earners, the long-term profitability model would, over time, just decline.
The result of this generational shift, winning the next generation of spenders, this is where the data becomes truly defining. It's the moment the strategy paid off.
We have to stop and dwell on this specific data point because it validates the entire pivot.
Okay, lay it on us.
As of Q3 2025, millennials and Gen Z account for a remarkable 36% of AXP's total billed business.
36%.
Think about that. In a very short time frame, this younger cohort has achieved spending parity with the traditionally dominant Gen X cohort.
It's a complete structural realignment of their customer base.
It is. And the acquisition velocity behind that figure is even more compelling.
What do you mean by velocity?
It suggests the spending is sustainable. In Q3 2025, this same cohort represented 75% of all new U.S. consumer gold and platinum card acquisitions.
75%. So 3 out of 4 new premium cards are going to younger consumers.
Yes. They aren't just acquiring low-tier customers. They're successfully seeding their most profitable premium products with consumers who are decades away from their peak earning and spending years.
This speaks directly to future lifetime value, or LTV.
Absolutely. The proprietary closed-loop data shows that these younger customers are not only adopting the cards, but they transact 25% more frequently than older cohorts.
More frequently?
Yes. So this sets AXP up beautifully for the next 2 decades. They have captured a generation who will continue to use the card for daily life, travel, and business as their incomes and spending needs grow exponentially.
This is perhaps the most significant non-financial metric of success in the entire analysis.
I think it is.
Beyond the U.S. consumer, AXP is clearly diversifying the growth drivers, specifically looking internationally and at the B2B sector. Let's look at the global strategy first.
Historically, AXP focused very heavily on the U.S. and a few key European markets.
Right.
Now, international growth is their fastest growing segment, demonstrating the highest momentum.
And numbers back that up.
International card services billed business grew 13% FX adjusted in Q3 2025, which is notably outpacing the total company growth of 9%.
So international is pulling the average up.
It is.
What's fueling that 13%? Are they just issuing more cards, or is it a structural change in how they operate overseas?
It's more of a structural change. They are shifting away from relying on third-party local bank partners who capture part of the discount rate.
The old way.
Right. And moving toward establishing their own proprietary issuance model in more markets. By bringing issuance in-house, they replicate the full closed-loop economic advantage, the data fidelity, the pricing power in those high-growth international areas.
They're exporting their moat, essentially.
That's a great way to put it.
Now let's talk B2B, which is crucial because the global business-to-business payments market is, 100 times larger than the consumer market?
It's orders of magnitude larger, estimated at over $125 trillion globally.
So a huge prize.
A huge prize. And AXP's traditional commercial services division used to be focused very narrowly on corporate travel and entertainment cards.
The expense account cards.
Exactly. Now, they are driving the blueprint strategy, pivoting to provide full-stack working capital and accounts payable, or AP automation solutions.
So they are trying to move beyond just offering a way to pay for hotels and flights and trying to capture the process of paying suppliers, vendors, and contractors.
Precisely. And the key target here is the small and medium enterprise, the SME segment, which already drives 82% of commercial services volume.
So they're leaning into their strength.
They are. The goal is to digitize and convert the trillions of dollars currently moving via antiquated B2B methods like paper checks or slow ACH payments into virtual card payments processed through AXP.
That sounds like a heavy lift. How does a company focused on status cards move into the world of enterprise software?
Well, it requires becoming an embedded software layer, not just a card company. Their product, American Express Business Blueprint, is central to this.
Okay.
They need tools that allow a business owner to manage cash flow, pay vendors, and automate reconciliation seamlessly.
And are they building that themselves?
They are, but that's also why their strategic acquisitions, such as the AP automation company Nintendo, are so critical. They are buying the software expertise necessary to embed AXP payments deep into the enterprise resource planning, or ERP, systems that businesses rely on every single day.
So the goal is to make AXP the default payment rail inside the software businesses already use.
If they can automate the AP process using their virtual cards, they unlock a massive greenfield revenue opportunity.
This aggressive expansion and pivot to software-defined utility raises the ultimate question. How does AXP defend itself against the competition? Let's move to Section 4, focusing on the competitive moat and ecosystem lock-in.
This raises an important question. How does AXP defend against the competition, especially given the cost of those rewards and the, annual $5 billion marketing spend?
Yeah, how do they protect all that investment?
The sources identify three reinforcing pillars that collectively form a formidable, durable economic moat.
Okay, pillar 1, the network effect, but specifically the premium network effect.
Right. It's a quality, not quantity, network effect. As AXP continues to successfully acquire high-spending cardholders, the type of customers merchants desperately want, they become indispensable to those merchants.
And acceptance isn't really an issue anymore, is it?
Not in the U.S. Merchant acceptance is now at near parity with Visa and MasterCard in the U.S., virtually eliminating the historical acceptance hurdle AXP faced decades ago.
So broad acceptance makes the card more valuable.
And that, in turn, makes the card more valuable to the premium cardholders. The cycle is complete. High fees fund high rewards, which attract the highest spenders, who then pressure the last few merchants into acceptance.
Okay, pillar 2, intangible assets, specifically brand and status. This is what allows them to charge that eyebrow-raising $695 annual fee.
This is the asset that is almost impossible to replicate. The Centurion brand is pure cachet.
It's a status symbol.
It is, and it's what allows AXP to charge those high fees, which the source material cleverly describes as a negative acquisition cost.
A negative acquisition cost.
Meaning customers are actually paying AXP for the privilege of holding the brand status, rather than AXP having to bribe them with huge sign-up bonuses alone.
We saw this play out in the financial results, didn't we?
Absolutely. The Q3 2025 data showed card fees grew 18% FX adjusted. That immense sustained pricing power proves that the brand value, the emotional connection, and perceived status of the card is entirely inelastic.
People might grumble about the fee, but they pay it.
You pay it because the card represents something more than just a piece of plastic.
And pillar 3, switching costs. How do they actually lock the customer into the ecosystem once they've paid that premium fee?
It's both operational and financial lock-in. The proprietary membership rewards points program is a currency unique to AXP.
A proprietary currency.
Yes. Customers accumulate these points, sometimes hundreds of thousands, which creates a substantial psychological switching cost. If you leave AXP, you lose access to the best transfer partners and the ability to maximize the value of that currency you've been earning.
And the co-brand feels deep in that lock-in.
They do. Critical co-brand partnerships, like those with Delta, Hilton, and Marriott, integrate the points currency directly into travel loyalty ecosystems. And the data backs this up. 82% of users cite membership rewards as a primary reason for their loyalty.
Now, despite that wide moat, AXP is in a ferocious competitive environment. We need to distinguish between the threat from rival banks and the threat from the new fintech entrants.
Right. Two different battles. In the consumer space, the knife fight is against issuers like Chase and Capital One.
The Sapphire and the Venture X.
Exactly. Chase's Sapphire products and Capital One's Venture X are direct, aggressive competitors for the affluent consumer. They have spent billions of dollars matching or even exceeding the sign-up bonuses AXP offers.
So how does AXP maintain retention rates above 96% when competitors are throwing so much money at their customers?
They rely heavily on non-replicable service differentiators.
Like what?
A pure bank struggles to build and maintain a global network of Centurion lounges, or to provide true, bespoke concierge services. AXP argues that the total ecosystem experience, the service, the crisis management, the feeling of being taken care of is what keeps the retention rates high, not just the points.
So the value proposition is less about the numbers and more about the experience.
That's the argument, yes.
And what about the challenge from the fintech disruptors like Brex and Ramp in the B2B space? That's a fundamentally different challenge, isn't it?
It is, because they compete on software utility, not on status or rewards.
Right.
Fintechs like Brex and Ramp have already cornered about 90% of the tech startup card market. They offer cards embedded within sophisticated expense management software, providing real-time controls, receipt automation, easy integration into accounting platforms.
All the things a startup CFO would love.
For a startup, that software utility is often a better moat than a few extra points.
So AXP, the king of rewards and status, was forced to play catch-up by building out its business blueprint and buying companies like Nintendo.
Exactly. It was a clear realization that in the corporate and SME world, software utility is rapidly becoming the superior moat. While AXP still relies on its traditional T&E dominance, the future of B2B is about making payments invisible and seamless, and the fintechs pioneered that approach.
We absolutely must devote some time to the colossal partnership with Delta Airlines. This is more than just a co-brand deal. It's a structural pillar for both companies.
It is the single largest, most successful co-brand partnership in financial history. The scale is almost incomprehensible.
Give us the numbers.
AXP's remuneration to Delta, that's the fee they pay for selling the cards and accessing the loyalty system, reached $7.4 billion in 2024.
$7.4 billion.
And that figure is forecast to grow toward $10 billion in the near future.
$10 billion to a single airline is transformative for Delta's balance sheet.
It represents a massive slice of Delta's total revenue, making it one of the airline's most critical non-operational revenue streams.
That's like a whole separate business for them.
It is. And to highlight the impact, the sources note that the spending volume on these Delta co-brand cards accounts for nearly 1% of the entire U.S. gross domestic product.
Wow. That's a staggering metric that really brings home the scale. But we have to address the single point of failure risk that comes with concentrating so much financial activity in one partnership.
That risk is real, and the market absolutely recognizes it. The loss of the Delta contract would be catastrophic for AXP.
How so?
It would immediately remove a huge chunk of high-volume spend and severely damage the value proposition of membership rewards.
So what's the likelihood of that happening?
Well, the contract is secured through 2029, and the mutual economic dependency is so profound that the renewal probability is considered very high.
It's mutually assured destruction if they split up.
In a way, yes. Delta relies on that $10 billion fee stream to maintain its own profitability and investment, creating a deep mutual alignment that goes way beyond a simple business negotiation.
Now let's ground this strategic discussion in the actual financials. Moving into Section 5, Financial Health and Capital Discipline. We've seen the strategy, but how robust are the numbers?
The performance highlights from the recent period are exceptional, and they prove the strategy is translating into real dollars. AXP reported record revenues of $65.9 billion in FY 2024.
And what was the growth rate?
That represented 9% year-over-year growth, and this is high-quality growth, given the economic environment.
And the earnings power looks leveraged, meaning growth at the top line flows very efficiently down to the bottom line.
It does. Earnings per share, or EPS, surged 25% in FY 2024 to $14.01.
25%.
And Q3 2025 continued that momentum with another 19% EPS growth. This model leverage is critical. Total network volume grew 9% in Q3 2025, driven by the successful pivot, specifically international growth and the high-volume spending from the newly acquired U.S. consumer segments.
The single most compelling metric in the entire report for me is their profitability relative to the rest of the financial sector. We are talking about their return on equity, or ROE.
This is the metric that justifies AXP's premium valuation. They consistently deliver ROE above 30%. In Q3 2025, it stood at a remarkable 36%.
36%. And how does that compare to a normal bank?
If you contrast that with the typical ROE for a large diversified bank, which sits around 10% to 15%, AXP is in an entirely different league of capital efficiency.
What allows the closed-loop model to generate double or even triple the ROE of a typical bank?
It's the unique combination of recurring fee income and the superior data-driven underwriting.
The two things we've been talking about.
Because they earn that stable, high-margin card fee revenue year after year, and because their proprietary data allows them to manage credit risk more effectively than a blind issuer, they can generate massive profits with a comparatively lower equity base.
It's the definition of a high-quality compounder.
It really is.
That kind of exceptional ROE requires disciplined capital management. So how is AXP rewarding shareholders and sustaining that EPS momentum?
They are ruthlessly disciplined. Their primary vehicle for driving EPS outperformance is aggressive share buybacks.
They're buying their own stock.
Management views AXP stock as an extremely high-return investment. They returned over $4.5 billion to shareholders via buybacks in 2023 and another $2.5 billion in Q2 2025 alone.
This mechanical reduction of the share count must provide a guaranteed uplift to EPS.
Absolutely. The average diluted share count is declining by about 3% year over year. This acts as a reliable floor and an accelerator for EPS growth, ensuring that even if revenue growth slightly dips, the EPS figures remain robust.
And what about dividends?
They also complement this with consistent dividend growth. They increased the dividend by 17% in January 2025, all while keeping the payout ratio conservatively managed around 20% to 25%.
So they're retaining most of the profit.
The vast majority, yes, for reinvestment or buybacks.
And what about the underlying financial strength? Do they have enough buffer to handle the credit risk that comes with the hybrid model?
They maintain what the sources describe as a fortress balance sheet, their Common Equity Tier 1 ratio, a key measure of bank capital health.
The CET1 ratio.
Right, that was 10.5% in Q3 2025, which is safely above the 7.0% regulatory minimum.
So they have a good cushion.
A very good cushion.
Yeah.
And with approximately $40 billion in cash and equivalents, they have significant liquidity, providing a crucial safety net for any unforeseen credit shocks.
And circling back to the intangibles, we must remind the listener that these impressive financial results are underpinned by assets that don't even appear on the balance sheet.
That's the true long-term value.
Yeah.
The unrecorded assets include the immense brand equity of American Express and Centurion, the proprietary closed-loop Level 3 data, and the intrinsic value of the network effect itself.
The real moat.
These assets are the barriers to entry that keep competitors scrambling and ensure the company can maintain that 36% ROE indefinitely.
Now, we must turn our attention to the necessary counterpoint. Section 6. Key risks and headwinds. So what does this all mean? It means the success of the hybrid model comes with a permanent, unavoidable burden.
Yes.
AXP is directly exposed to the American consumer's financial health in a way its higher-valued network peers are not.
That is the essential risk. Visa and MasterCard sell shovels to gold miners. AXP is the miner itself.
I like that analogy.
The rapid growth in their loan book, which was up 12% in 2024, necessarily increases the surface area for credit risk. In a severe economic recession, the market knows that AXP would be required to increase its provisions for credit losses, which directly reduces EPS, potentially wiping out months of hard-won growth.
Are we seeing worrying signs of strain in the current credit quality data?
We are seeing a normalization, not yet a strain.
A normalization.
Credit metrics are rising back toward pre-pandemic levels, having benefited from the unusually low delinquency rates during 2020 to 2022.
So what are the numbers now?
The 30-day delinquency rate was 1.3% in Q3 2025, and net write-offs stood at 2.0%.
It's 2% high.
While that 2.0% is significantly higher than the pandemic lows, it is still exceptionally healthy, reflecting the fact that AXP targets prime and super prime customers.
Okay.
But crucially, they had to provision $5.2 billion for credit losses in 2024, demonstrating that while the rate is manageable, the absolute cost of credit is a massive material expense that is highly cyclical.
Let's discuss the constant overhang of regulatory threats. The first is the Credit Card Competition Act, or CCCA.
Right.
While it targets the VMA duopoly, how exactly could a ripple effect harm AXP, which operates outside that interchange structure?
The CCCA aims to introduce competition by giving merchants the power to route open-loop transactions, so Visa and MasterCard over alternative, cheaper networks.
Okay, but AXP is exempt.
They are exempt from the direct mandates of the bill because they're a closed network, but the competitive landscape would fundamentally shift if the cost of accepting Visa or MasterCard fell dramatically.
So if VMA's fees drop, merchants would have massive leverage to negotiate AXP's discount rate downwards, undermining the reward structure.
Exactly. If the regulatory pressure successfully compresses the fees charged by the open-loop networks, merchants will immediately turn to AXP and demand lower discount rates, arguing that the competitive playing field has changed.
And if that happens,
If AXP is forced to lower its high discount rates, the primary funding mechanism for its rich rewards, the entire premium flywheel, is undermined. That's the systemic risk the CCCA poses to AXP.
and the Basel III Endgame rules, these generated significant concern, especially regarding capital requirements for unused lines of credit on charge cards.
The initial proposals were indeed scary. They threatened to significantly increase risk-weighted assets, forcing AXP to hold substantially more capital against its existing charge card portfolio.
Which would have hurt their buybacks.
It would have severely constrained their ability to do share buybacks and maintain their current high ROE. However, the finalization of the rules, specifically imposing a manageable 2.5% stress capital buffer, or SCB, for 2025, suggests that the outcome is far more favorable than initially feared.
So 2.5% is considered manageable for AXP. Why is that?
Because AXP's existing capital ratios, that CET1 at 10.5%, already provide a healthy buffer. While capital requirements generally trend upward across the industry, the impact on AXP appears to be more of a minor constraint on the pace of share buybacks rather than a significant restructuring mandate.
So they can absorb it.
They have enough internal capital generation to absorb that 2.5% buffer without distress.
And the CFPB's late fee rule.
That's the least of their worries. The CFPB rule targets the high late fees often charged by subprime and non-prime issuers.
Not AXP's customer days.
Right. Given AXP's focus on prime and super prime customers who generally pay their bills on time, late fees comprise less than 1% of AXP's total revenue. It's a non-systemic headwind, unlike the CCCA.
Let's look at the long-term industry shifts. The rise of real-time payments, RTP, and the FedNow system. Do these low-cost, instant bank-to-bank settlement systems pose an existential threat to the card networks, including AXP?
Theoretically, yes. I mean, they represent the ultimate long-term threat by offering low-cost, instant settlement that bypasses card fees entirely.
But there's a catch.
However, the current threat to AXP is heavily mitigated because RTP systems fundamentally lack two elements that AXP's premium customers demand.
Which are?
First, the credit mechanism. RTP systems are bank-to-bank debits. They offer no float, no credit line, no ability to buy now, pay later.
And a lot of AXP spending is on credit.
A majority of AXP's transaction volume is dependent on the customer utilizing that line of credit. Second, they lack a structured rewards funding mechanism.
No fees, no rewards.
Since RTP is nearly free, there is no discount rate revenue to fund the generous rewards that keep AXP customers loyal. Until RTP systems can reliably replicate the benefits of credit and rewards, AXP's premium moat remains largely intact, though they must monitor the technology closely.
Let's pull all this analysis together in Section 7, valuation and the hybrid discount. When we look at the trading multiples, AXP sits in a distinctive quadrant compared both to networks and to traditional banks.
They absolutely do. If you look at the forward price to earnings, or PE ratio, AXP trades at about 20.7 times expected earnings.
Okay.
Now, compare that to Visa, around 25.3x, and MasterCard, closer to 29.6x. This disparity defines the hybrid discount.
The discount exists purely because of the credit risk. Right?
Exactly. The 20% to 30% gap in valuation compared to VMA is the market's rational price for AXP, retaining the cyclical risk of the loan book and having higher capital requirements under bank regulation.
The market wants safety.
The market rewards the capital-light pure network model with the premium multiple because those earnings are safer and more predictable during a recession.
But then you compare AXP to a traditional bank, and AXP commands a massive quality premium.
And that premium is entirely justified by their superior profitability. Their 36% ROE is what separates them from the pack.
So it's a premium over banks, a discount to networks.
That quality premium comes from the recurring, high-margin, subscription-like card fee revenue and the structural advantage of the closed-loop data moat. Banks simply cannot generate those returns, which is why AXP trades at a multiple that is usually reserved for technology or luxury goods companies.
For investors, what does the current valuation context tell us about how the market views the success of the pivot?
The current PE ratio, above 20x, is at the upper end of AXP's historical trading range, which used to hover between, say, 12x and 18x.
So it's not cheap right now.
This tells us that the market has fully recognized and priced in the success of the demographic pivot, the durable double-digit fee growth, and the successful execution of the growth plan. It suggests high confidence, but it also means the days of finding AXP significantly undervalued are likely past.
And finally, we have to mention the Berkshire factor. Warren Buffett has held AXP since the 1990s.
Indeed, Warren Buffett's Berkshire Hathaway remains the largest single shareholder, owning roughly 20% of the company.
20%.
And that long-term endorsement is often viewed by investors as a definitive validation of the company's powerful economic moat, its brand durability, and the exceptional quality of its management. It provides a level of shareholder confidence that is nearly unmatched in the financial sector.
To synthesize what we've covered today, AXP has pulled off a remarkable feat. They successfully reinvented themselves, proving the closed-loop model is a powerful competitive advantage in the modern data-driven financial landscape.
It is a high-quality compounder, delivering that best-in-class 36% ROE and double-digit revenue growth. Their aggressive, successful capture of millennials and Gen Zs ensures their relevance for the next couple of decades, mitigating the long-term demographic decline risk.
However, you have to enter into this understanding the dual nature of the risk. You are buying a hybrid.
You must always monitor the credit cycle. AXP is fundamentally a lender exposed directly to the American consumer's balance sheet. That exposure, coupled with ongoing regulatory threats like the CCCA, means AXP will always trade at a discount to its pure network peers, regardless of its superior ROE.
The source material heavily emphasized AXP's reliance on those crucial intangible assets, the brand, the status, and the willingness of customers to pay high fees like $695 annually simply for the privilege.
It's the emotional connection. The card is a badge.
Which leads to our final provocation for you to consider. AXP relies on this historical status symbol, the allure of the Platinum or Centurion card, to justify those massive premium fees. But we are seeing the rapid rise of software-led, utility-focused payments platforms like Brex and Ramp in the B2B space, which are trying to make payments and expense management an invisible, commoditized utility, reducing the emotional attachment to the payment rail itself.
Right, software over status.
Will the enduring power of the AXP premium brand, the status symbol, continue to justify paying high fees when software is increasingly making the core payment function an invisible low-cost commodity? That tension between status and pure utility is the fundamental management challenge AXP faces in the coming decade.